I've asked my colleague Ted Truman to join us on the platform. You nicely introduced him, so I don't have to do so. I will simply add to your praise for his having played a central role in the creation of SDRs, that he was the person who gave me the idea to suggest that the 10 commandments at the fund denoted the presence of a higher power. So credit or blame for that one goes to Mr. Truman also. I'd like to start the discussion by going back to something you said at the outset of your remarks, which I think is terribly important. You talked about the mutual assessment process, the MAP, and the analysis in the fund that successful implementation of that strategy could increase global economic output by $2.5 trillion over the next 5 years, 2.5% higher growth, something like 30 million jobs. I at least think that achievement of that kind of outcome would be historic. For the following reason: most of us in this room think of international economic coordination as a kind of given, a good thing, and something that we spend a lot of our time working on. But in the academic world, there's great skepticism about the benefits of policy coordination. At many periods of time, there's been great skepticism in official circles about the benefits of policy coordination. Yet here you are, very boldly, I would say, positing that global growth could be affected by an order of magnitude by effective implementation of a coordinated growth and stability strategy. Because I think it is so important and potentially of historic significance, let me ask you to elaborate a little bit on the way it has evolved so far. You said, I was enormously encouraged, you said in your opening remarks, the spirit of coordination is still alive, and you suggested that the country's submissions to the MAP had not been so discordant. Now the next step was to take it to the country level. Talk to us a little more about how the process has worked so far, how you see it evolving now over the next even 6 months to the Seoul Summit, where you go to the country level. Can you foresee a really effective implementation of this strategy with the kind of really very major payoffs that would be resulting?
Yeah, first thank you for this comment, because I don't know if it's of historic importance, but I think at least that for the coming years it's very important. Well, first to the first part of your question, the process. Well, it's challenging. It's something new. When leaders decided in Pittsburgh to do something like this, I guess that most of them hadn't in mind exactly what it would be. And when we came to different countries asking for information, figures, forecasts, some had them, some didn't. Some had them and didn't want to give it. Well, you have all different kind of situation. So on a practical point of view, it wasn't that easy to do it. Certainly, going forward, it will be better and better, providing that the results are interesting. But so that was why the first step was for us so important. Well, it worked. But let me give you just an example, which is not secret. We had some troubles with our Chinese friend because they were arguing they don't have forecast for the next 3 years. And so, well, surprised, maybe. And then the question was, the point is not that we don't have forecast, but we have too many. And we didn't choose. So we don't want to be forced to choose before the time we decided to, and you're not going to force us to make a choice before the right moment for us to make a choice among the different set of forecasts that we have coming from different think tanks or university or whatever. So it was a bit tough. But finally, and that's a very good sign, that's why I took this example, could have others, the Chinese understood that it was in the interest of everybody for that this process will work. And so finally, they made their choice. I don't know how they made their choice. We discussed with them. We provide them our own estimate. And finally, we agreed on possible paths for the Chinese economy to put in the system, which is a rather large and complicated nonlinear model with today 6 zones, and that we're going to split in more precise outcome for different countries. The way it works is that we started with what is the most obvious that will certainly take place, which is fiscal consolidation in many countries, including European countries, and to see what will be the result on the global economy. And starting from the baseline, when you add what is already decided by most European countries, not only European countries, but that's a good example, in terms of fiscal consolidation, of course, it produced some negative effect on growth looking forward. So the whole growth goes down. And then we say, okay, how can we go back to the baseline? Because the baseline is only the baseline. You have an upside, but you have also a downside. So then came the idea that some rearrangement in economic policies in emerging countries, boosting domestic demand as the Chinese, but not only the Chinese, are committed to do, may have the reverse effect, which you can try to estimate this, and you see that's true, that it can offset and more than offset the negative effect of fiscal consolidation in other parts of the world. And then, on top of that, you have, which delivers only in 2 years or 3, but it's a medium-term exercise, the structural reforms that could be implemented in many countries, Europeans, not only European countries, we again add some push, some lift to the growth rate. And so taken all around, you see 2 things. You see the most evident one, the one you quote, which is that it's a cooperative game, and that if everybody pushes in the right direction, you have a result. And the second thing is that there is a rationale to do this, because globalization is not anymore just a topic for speeches, lectures, and this kind of things. We are really experiencing with this crisis the fact that the butterfly effect has a reality, and there's something happening in the housing sector in Maryland at the end of the day will have consequences on the other side of the world. So you cannot just say, well, I'm not interested in what's happening, let's say, in Europe these days, where it's the weakest part today of the global economy. I was discussing with President Lula 3 weeks ago, I was in Brazil, and he said very clearly, well, I'm interested in what's happening to the Brazilian economy, and of course I have to be concerned of what's going on around the Brazilian economy, but I understand that I cannot just ignore what's happening in the rest of the world, because it will have a lot of consequences, and also on what is my main topic on top of my agenda, which is the Brazilian economy, which is absolutely normal for a Brazilian president. So this idea that you have to help the other part of the world to go in the right direction. You may have to help them with financing when it's necessary. It's an idea which is becoming stronger and stronger. And I say this here in the Peterson Institute with member of Congress or staff member of the Congress being here. The question has been asked perfectly legitimately of why should the IMF help European countries, they're developed countries, why should we do this? Is it in the interest of everybody? Yes, it is obviously in the interest of everybody, because there's no way to expect to have 3, maybe 4, a rate of growth of 3 or 4 in the US if it goes worse than it's already, which is not that good, in the European countries. So this idea that we're in the same boat, which was intellectually understood by everybody, is now really more, has a stronger appeal for many, and the map exercise gives some figures, shows how big it is, as you say. So really I think that we may be at a turning point in economic cooperation.
Let me ask a follow-up on the European dimension of that, if I might, because that is, of course, the big new event over the last 6 months. And I want to ask if you factored into your analysis one, I think, implication of that. You mentioned toward the end of your remarks that the question of the global imbalances had kind of been pushed aside lately because of other priorities. One concern that I have is that what's happening in Europe is going to create a new set of global imbalances. The weakness of the European economy, combined with the weakening of the exchange rate of the euro, I think will lead over the next couple of years to a substantial increase in the European trade surpluses. Indeed, that may be the one source of growth in Europe, understandable from a European standpoint. But if that's right, that European trade surpluses are going to jump up sharply, and if the Asian surpluses continue large and even rising again, as the fund's forecasts now show, that would tend to throw the U.S. deficit up again sharply, maybe back up to record levels. So the imbalances problem could be back to a substantial extent. Question, do you share that concern? Is it factored into your analyses in the MAP? And if so, kind of what additional steps might be needed to deal with that?
Well, it's certainly a concern, you're right. The question is how big the concern should be. Who knows what will be the level at which the euro will stabilize? We just don't know. Let me just remind you that at the launching of the euro, it was 1.17 dollar, which was seen as a kind of a historical average, something like this. So we're very close to this now. So from some point of view, it's rather the level of 150, even 160 that we reached in the last year, which was odd, and not the level we're today. The other remark is that what we think about when we talk about a European trade surplus is mostly the German trade surplus, and the US Treasury makes it very clear during the G20, at least in the discussion in the lobbies. But you know, 75% of the German surplus is made on Eurozone countries. So as a whole, the surplus of the Eurozone today, the Eurozone taken as a whole, is close to zero.
Now, yeah.
So it may increase, you're right, of course. We're not in a world where prices doesn't matter. It would be a different world. So if for a long time the value of the euro stay where it is, then the consequences you are talking about may happen. But I don't see this as a big threat for the future. We're still back to the two main players in this global balance. They're not alone, that's right. And it may change a little, that's right too. But still, we are with the two main players, which are the US on one hand and China on the other. The good news is that what the Chinese have done during the crisis, mainly a big stimulus package aiming to shift the growth model from a totally export-led growth model to a more domestic-led growth model, goes in the right direction because it's consistent with the revaluation of the renminbi, which may be underway at a slow pace, but at least a significant sign has been given. On the other hand, however, renminbi or not, the shift to a more domestic-led growth model will lead to less exports. On the other hand, at least until recently, the rising saving rate in the United States meant a less deficit, less current account deficit, and also a rebalancing from this point of view. I'm not sure that this rising saving rate is going to last for very long. So, and part of the recovery today is more financed by going back to traditional consumption. So this part of the rebalancing is a bit at threat. But nevertheless, that's the main problem we have to address. Again, I think that even if our Chinese friend doesn't like that we quote this, but I'm sure that nobody here will repeat, the fact that this sign has been given by the Chinese authority just 1 week before the G20 and in line with the map and so on, I'm not saying at all that they did it for this reason, but I can't avoid to think that it may have some link.
Good. Congratulations. Ted.
Well, thank you, Fred, and thank you, Mr. Managing Director, for your compliments. I will say that to Your Majesty that that success has many handmaidens, and I'm sure you would agree. My question, first question, would come back to a good idea. Otherwise, we would auction it off for the benefit of the endowment of the Institute.
Frame it and give it a place of honor.
The last point, when you were talking about the mandate and the governance reforms, and you indicated that one of the deliverables, as they put it in this business in Korea, will be the quota and IMF reform package. And which is very important, and as you know, I certainly think it's important. There are some people, including myself, who think that one of the important elements of that package, maybe even more important than the 5% shift in whatever it means to whoever it means, is the question of the composition and size of the executive board. And that this is essential as part of the package in order to both to improve the legitimacy of the fund and to improve its internal operations. Maybe it goes along with your diversity theme, if I might put it that way. So I would like to know whether you agree with that, and what do you think can happen on that score, and should happen on that score, as part of that sole deliverable.
Well, first I agree. I think a lot of emphasis and the spotlights are on the quota, which I'm not saying is not important, it is important. But the size, the composition of the executive board is even more important because, you know, each and every people knowing the fund knows that no decision, I think since I'm there, no decision has been made with less than 70 or 80% majority. So the question is not that the country will have a 1.8 or 1.9 voting power. It doesn't change at all. The reality is the dynamic in the board, the way people may convince other people and convince their own capital, and then we're back to the right question. Quota are important. Don't say that I'm saying it has no interest, but what you say is even more important. So the question is, let's be candid. When you see the board of the IMF, you have among the 24 seats 8 Europeans, sometimes 9, depending who is in the chair of the Mexican, Spanish, Venezuelan constituency. And I'm fine to have my European fellow citizen around me, but I guess that if I wasn't European, I would be very upset about that. So the fact that in one way or another, this has to change over time, I think is understood even by European countries. The problem is, one thing is to understand the need to change this, another thing is to do it. And intellectual arguments are very interesting, but when you come to the real stuff, which is, okay, then if you want to go from 8 chairs to 6 chairs, say, means that 2 European chairs have to disappear, then you enter some kind of a problem. So one way for me to solve the problem is to say that's not my business. That's the membership business. So they do what they want, I will be happy, I can provide advice, but it's not my business. Well, won't be very bold, and I can try to do it partly my business, but then changing this in my business also means that the failure will be my failure, which I don't like so much. So I think the Europeans, because the Europeans are at stake, do understand this. At least the big Europeans, because they're not at stake. The small Europeans find it a bit bitter and explain, which is often true, that they're doing a lot of job. When you look, for instance, at the Dutch constituency, they're doing a lot of work because they have a lot of program countries and all these kind of things. So you can build very interesting data to explain that a lot of the fund activity grows through this small shares. Iceland for the Latvia for the Scandinavian, Ukraine for the Dutch, and so on and so forth. So this makes not the things very easy. The bottom line is what? The bottom line is that really it's mostly in the hand of the Europeans on one hand, because they need to make a decision at the European Council. Let me just remind you that when I was the finance minister of my country 10 years ago, a little more than 10 years ago, 11 years ago, I proposed the German to have a joint chair as a first step to a Eurozone chair. And as a proof of my good faith, I proposed Hans Eichel, who was my counterpart in Germany at this time, that it would be on a rotating basis, 2 years, and that we could start with the German and the French would accept for the first 2 years to be just alternate. And this idea, well, had some interest and had some steam until the French Minister of Foreign Affairs stepped in, explaining that it was a very interesting idea, but if we start that way, then we will have to do the same thing at the Security Council in the UN. There was no way. And that was the end of the story. So my idea is that they should go in this direction, consolidating as either a Eurozone share or, if not, at least less European share. But again, it's mostly in the hand of the European head of states to be bold enough to say, now we have to find a solution. There's another player in this, which is the US, as Meglund Sagers knows very well. Because the Article of Agreement say that we have 20 chairs. In fact, we have 24. But to have 24, we need an approval, or at least no refusal, and to have this we need 85% majority, which means that the US, as you know, having more than 15% of the voting right, may decide that game over, now we're going to go back to the 20 shares. The problem is it's not that easy. It's a good idea. We could say that will really, it shakes the thing, and then some result will have to come out. The problem is that doing this, the result may be that if the resolution asking for renewal of 24 shares fail, the day after we have only 20 shares. Who disappears? The smallest shares, including the 2 African shares. Not sure it's a political result that anybody wants. So all this is a bit complicated. But nevertheless, I agree the chair things is at least as important as the quota thing.
Well, we doubt that you'll duck the issue, and we wish you best luck in resolving it. Okay, the floor is open. Mike? Right here. Yeah, introduce yourself and then fire away. There are mics coming around and a standing mic toward the back.
Hi, Michael Pomerleano. I'm with the World Bank. I thank you very much for your presentation on the future of the fund. But let me cite a few recent articles. Paul Krugman, who was, I render a lot of credibility yesterday, talked about the third depression, where the levers of fiscal and monetary are no longer useful at this stage. Nouriel Roubini has an article in the FT talking about the fallacy of the great support, which basically allows country to exit, banks to exit with your money, so you are basically a placeholder. And I wrote an article in the FT, Martin Wolf's column, in the Economist Forum last week, pointing out that the crisis in East and Central Europe is virtually inevitable. And the reasons are twofold. One is that the net financing need is about $500 billion there. And secondly, 51% of the system is owned by European banks that are going to need between 600 and 1 trillion in capital. So first place they're going to exit is Eastern Europe. So before all those reforms happens, what are your assessment about those prospects in the next few months?
Well, if you have paper by Krugman, Roubini, and yourself, I don't know if I can add something. But you're right. The problem in Central and Eastern Europe, the problem with the way the banking system and the financial system as a whole is going to react, is likely to react, the consequences on the Western banks. But then, as I said before, the feedback effect on the rest of the Europe and maybe the rest of the world is huge, huge. And in the more extreme case, may request a lot of money to fix the problem. The question is, it's not only a question of money, it's also a question of rules. And that's why the reforms that the FSB is supposed to provide are so important. The well-known question of the host, the home country, which kind of regulation, which kind of supervision is applied to a subsidiary or branch, and it's not the same thing from a French bank in Hungary, for instance. That's something which is totally unclear. And so the way for crisis resolution, the way to step in and to try to help is a bit fuzzy, just because information doesn't circulate from supervisor to other supervisor, just because the whole set of information and resolution mechanism that we would need doesn't exist. During the recent crisis, the so-called Vienna Initiative was an attempt, very practical and pragmatic attempt, to address this question, but it addressed an immediate problem of the crisis. It doesn't address what you're talking about. So there are good reasons to not to believe that the crisis is behind us, that we're going to business as usual. In Eastern and Central Europe, you're right, not only in this part of the world, but this one is more today in the headlines. The problem remains, especially through the soundness of the financial sector. That's absolutely right.
Okay, we had a hand over here. Yeah, Marie?
Thank you. I have about a dozen questions, but I'll limit myself to one. And Ted, you almost had it right.
Introduce yourself first.
Oh, Jo Marie Griesgraber, New Rules for Global Finance. And the question is the quota formula itself. The way in which, you can go the political route and go, here's the results we need, or you can have a more disciplined, more even-handed, neutral approach through the formula. The formula of 2008 won't get you where you want to go in terms of reallocating votes from Europe to anybody else. So, what are you going to do about the formula?
Aren't you glad you came?
Yeah, I know what Ted will say.
Drop it.
Yeah, the problem is, this formula is the worst thing I've ever seen. Part of the problem comes from the fact that the quota have two goals. One is voice and representation. And as everybody understands, it has to be proportionate to the economic weight. What is the economic weight of the country? We just don't know, but we can imagine. But the quota have also another goal, which is to provide access to fund financing. So the formula has tried to be a kind of mix, and I have no patent in this, of economic weight, broadly GDP, whatever the way you make the math, and what the formula calls openness and volatility, which is supposed to reflect the possible need of fund support. Let's imagine a country, very big country, with no openness at all with the rest of the world. They won't need any kind of support for current account imbalances, so they won't need to have any kind of a zero quota will be fine. So from this point of view. So the question of mixing together two goals with one instrument is very well known in economic theory. It doesn't work. That's one of the reasons why this formula is unsatisfactory. Fine. Now, what can we do? If we reopen the formula to discuss, because the two questions I mentioned, GDP, openness, variability, are not the only one. Then you have a lot of other stuff with many very good reasons to appear, but finally making more troubles than the rest. Compression and all this kind of thing. If we reopen the formula, then the problem is that it may take a long time to find an agreement. If you don't reopen the formula, you're just unable to reach the target. So, from this point of view, the leaders, as always, have been very wise in the Pittsburgh communique, saying, starting with, I don't have the exact wording, but something was written, starting with the formula, which means that the formula gives the first idea of where the different countries are. But then we obviously will have to add some boosters to help the formula to reach the goal, because at the end of the day, everybody understands that the goal is not only a technical goal, but a political goal. So you have two ways to do it. Either you do that way, you keep the formula, and then you add to the formula what is necessary to be able to reach what you want to reach, or, which is more logical and more satisfactory from an intellectual point of view, just get rid of this formula and build something new. The only problem is that I'm afraid it will take more than 3 months to be done. And then who are the winners, who are the losers? Because at the end of the day, that's the real point. And my European friends, I think, will be very happy to go that way, because they know they're going to be the loser in this game. So if we reopen the formula and it takes 2 years, then we'll see in 2 years. At least you buy 2 years. So the one who are supposed to be the winners in this round, mostly the emerging countries, shouldn't ask to reopen the formula because it will only postpone the result. Better to have a result which is not totally fair, which is even difficult to understand, but goes in the right direction, than no result at all. But I know that's a point we may not share, because Ted always has been in favor of a, aesthetical and logic formula, which of course makes sense. The only problem is that you need everybody to agree with this. And I have attended, when I was the first 6 months I was in the IMF, before we had this reform in April, the 2008 reform, that you didn't like so much, huh? Well, before we had this, I attended a lot of meetings. First, it took me a long time to understand what was at stake, but then I succeeded at least partly. But what I realized is that around the table, everybody, with all due respect to Meg Lunsager and other EDs here, all the executive directors has a lot of logical argument to explain was this should be done that way or that way. But everybody has, has a computer under the table to see what was the result for his own country. And that was the only thing they're interested in, because the logical of the argument, that's fine, but what is really important, what's the result it gives. Then let's go directly to the result and forget about the way you get it. That's what I meant when I say it's a political choice. So if we know where we want to go, we will find a way to do it. Of course, it will be much better to have a formula which makes sense, which is not exactly the case of this one.
Bob, even though you quoted Ted instead of me in your article yesterday, you get the microphone.
Editors, what are you going to do? So I have a question about today and also one a little further out. Given the reaction of the markets over the last 2 days, do you think the G20's focus on deficit reduction and capping debt, which was a predictable headline out of the conference, do you think that was a mistake and they should have focused more on growth? And then more toward the future, can you talk a little bit more about this coordinated mechanism that you mentioned? At other times, the IMF has talked about a mechanism, a financing mechanism, where countries wouldn't even have to apply. There would just be, the IMF would say country A, B, and C are qualified to get loans. Is that what you're talking about?
On your first point, I think that the outcome of the G20 is rather good. Recognizing that the question is not fiscal consolidation or growth, but fiscal consolidation and growth. And that depending upon the countries, it hasn't the same effect. The Germans are arguing that they're totally Ricardian people, and so that fiscal consolidation will help to boost growth. I'm not totally convinced, but that's the kind of argument they're proposing, which from some respect makes sense, that any kind of threat to debt sustainability will be so damaging in the psychology of the German consumer that they won't consume anymore, and that finally you will have this Ricardian effect. So the idea that different countries, people having different history, need to have a different policy is something that I think has to be acknowledged. And finally, basically, that's what the communiqué said. But even so, fiscal consolidation is needed everywhere, at different level, at different pace, but needed everywhere. And that's why I think that the outcome of the G20 is not that bad. It's broadly in line with what we have in mind. It's broadly in line with what is being implemented by the different countries, and so giving a target, which is what is in the communiqué, which more or less, is what we can expect, is a good way to have a, to show how the progress can be made. Markets, if I knew how to make markets happy, I will do it immediately. But it's not that happy. Not too happy. No, really, I think that owing to the discussion which took place before the G20, which was really a bit tough and becoming to be counterproductive, I think that the outcome of the small consensus at a small level, but nevertheless a consensus on this by the which appears in the G20 communique is rather good. Now, on your second point, it's always difficult to have this question of a list, because when you give a list saying we're going to offer some kind of facility to country X, Y, Z, then you have the problem of those not being in the list, which may not be happy. You may have the problem of those being in the list, not being happy because they're in the list and that shows that they may have vulnerabilities. Then you have the problem of how you get rid of someone in the list if 6 months later you don't want to have them anymore. And it's very difficult. So I'm not sure the solution of a list is the easiest solution. Maybe the only one at the end, but it's not easy. Other way to do it would be to have a kind of a crisis mechanism that the IMF could switch on when it seems to us that we are entering a dangerous zone. And by itself, this mechanism may change a lot of practices, and then after a couple of months, if needed, we could back off and say we don't need any more. It's kind of alarm system. We're working on that. I can't really answer your question in detail because that's exactly on what we're working these days. Enhancing the FCL is something I think which will work, and I see that I don't want to talk on behalf of the executive board, but I feel that large majority in the executive board will follow this, and so it's fine. Creating the precautionary credit line is something which also I think is going ahead rather easily. Now, how we put in place a systemic framework is more difficult, and we need more work on this during July, August, September, in the run-up to the meeting. So it's too early for me to explain about this.
Okay, there's a question way in the back. Go to the mic, please.
Parameswaran from Agence France Presse. Just a quick question, sir, on the at least a couple of months ago, many economists flatly rejected the prospect of a double-dip recession, and now many of them are not ruling it out. What is your perspective on this? Thank you.
Well, the IMF hasn't changed his view. It's not the baseline for us. The double dip is not in the baseline, but there are rather high tail risk. And among the downside risks, you have the possibility of a double dip originated by a fiscal situation in some countries, by bubbles created by large capital inflows in some emerging countries, or the contrary, the sudden stop of this large capital inflows. You have many triggers, possible triggers to a double dip. But even if this tail risk do exist, and it will be ridiculous to say there is no risk at all, it is not in our baseline, and we do believe that unevenly, much faster in Asian economies and Latin American economies, in the middle for the United States, and lagging behind for Europe, the recovery will go on without a double dip.
Yep. Yeah, go ahead. Go to the mic.
My name is Don Kirk. I'm a journalist. I spent a lot of time in Korea. Just to change the subject a little bit, could you tell us what are the possibilities for IMF involvement in North Korea, and what effect IMF involvement might have on easing tensions on the Korean peninsula? Thank you.
I'm afraid I have no idea.
You were quoted by Yonhap, the Korean news agency, yesterday as making some remarks on this subject.
Well, I said yesterday to some Asian journalists that we did have in the past a technical assistance provided to non-member of the IMF, either because they were would-be members like Kosovo before it becomes a state, either because like today we're providing technical assistance to the Palestinian Authority, for instance, on request of the Palestinian Authority, and that if asked, we could consider providing technical assistance to other countries not being member of the IMF. But as far as I know, we don't have any kind of request like this one, so have nothing special to add.
Let me ask perhaps a wrap-up question because we're getting close to our closing hour. You've been right in the middle of another historic development and experiment, which is the creation of the G20, replacing the G8. You're in an ideal position. You're in the midst of the G20 discussions, but you're not representing a G20 member country, so you're in a somewhat detached but engaged position. What's your assessment so far? It's been about 2 years. The G20 has become, by its own words, premier steering committee for the world economy. In a way, though it's not formally your board of directors, it's in a way lending political impetus and instruction to what you do at the fund. What's your appraisal so far of this experiment to bring big emerging markets, developing countries, into the center of the global economic management process for the first time at the steering committee level? How do you think it's going, and how would you improve it going forward to try to make sure that it does work?
Well, as you know, the G20 did exist before at the finance minister level.
Right.
It was a Clinton initiative 10 years ago. And by the way, when the finance minister G20 has been created, the IMF was a member, considered as a member, not an observer, a member, not being a country, but nevertheless being a member of this nice gathering. And at the finance minister level, the G20 did meet, I don't know how many times a year, 2 times a year, something like this.
Once a year.
Twice
a deputy.
Okay, during all the period. The real change is the initiative by President Bush to convene in Washington on the 15th of November 2008, the G20 at the head of state level or head of government, and that's what you're talking about.
Yeah.
So my basic response is that I do believe that in 10 years from now, well, some of us will write memories or history books or things like this, there will be 2 or 3 important things coming out from this crisis, and one of these certainly will be the role played by the G20. The question is, will it last? And that's an open question. I started my remarks with this. Will it last effectively or just as, meeting without any kind of interest? That's a real question. I think that there's good reason to believe that it will go on, but you're never sure, of course. It's an informal thing, so it may just disappear without warning anybody just because of lack of interest. But we're not at this point at all, and that I think is one of the best news from the recent weeks. It works rather well. The good thing is that with the crisis first, the G20 had something on its plate, something to do, and that in the aftermath of the crisis, the idea that we proposed that if we wanted the G20 to be alive, they must have some agenda, but not only agenda, but also some kind of machinery, preparing papers, preparing decisions, likely to follow up, to report, on the contrary to what has happened to the G7. If we wanted this, we needed to build something like that. And that the slow lack of interest in the G20, in the G7, came not only from the fact that the G7 was only representing the rich countries and not the other one and so on. That was certainly part of the problem, but also the fact that there were no follow-up. People came, discuss, and go back home, and fine. Spend a lot of time writing a communique that nobody reads, and then fine. So if we wanted the G20 to be something, and I do believe it's needed, then there was a need to have some follow-up, something that will be asked from one meeting to the other meeting, reported at this time, discussed, and so on. And, of course, in my view, the IMF, not only the IMF, But for many questions, the IMF was the right institution to play this role. But on other questions, when the G20 wants to talk about climate change, of course, the World Bank is more appropriate than we are. So that's what's happening. And that's why the map is so important, because it's part of, maybe not the only thing, but it's part of this process that makes the G20 alive and having something to do and decision to make. So my assessment so far is that it works rather well. The difficult part of it is that already the G20 is no more 20. Not only it's more than 20, but also it's I don't know how much, because it varies from one meeting to another meeting, depending who the host wants to invite for a lot of political reasons, which are completely understandable, but which makes it at the end it's a total mess. So I think the G20 should have more defined rules. The G20 may have invitees, and one of the reasons to do so was to have a better representation of African countries, because the basis of the G20 being the 20 biggest economy in the world has some rationale, of course. It represents 80% or so of the global economy, 60% of the population, but still, when you have 20 countries, and even if it's 23 or 24, 20 countries in the room, I have, as I told you, 187 members, so it means that 167 are outside of the room. And those countries say, okay, we're not as big as the other one, but nevertheless, we don't want decision to be made in our name without being able to say our word, which is absolutely legitimate. So, in one way or another, the legitimacy of the G20 will be challenged. And my view on this, there may be different possibility, but my view will be that if we make it possible to have a convergence between the G20 and the governance of institutions like the World Bank or the fund, which finally is recognized as legitimate. The question of the fund legitimacy is on how big are the different countries, what are the quotas and so on, but not the fact that 187 countries are represented by 24. The constituency system is seen by everybody as rather democratic and works rather well. So that's not challenged by the members. And so in one way or another, I think that, I won't say emerging, but at least a greater consistency between the G20 plus and the board minus, which could reach to 22, for instance, in the middle of the two, which be something which makes sense and would give the effectiveness of the G20, as I say, is I think possible to have. The legitimacy is a little more difficult, and one possibility, again, maybe not the only one, but one possibility will be to go closer to the kind of governance system that we have in the fund. On top of that, it will help my job, because it's rather difficult for me, and I guess for Bob Zoellick the same, when a decision is made by the G20, which represent 80% of the voting power in my board. So decision made by the G20 is done. But then I come back and I tell my board, well, the G20 are decided that the doors are going to be painted in red. And then you have some guys, perfectly legitimately, from outside of the G20 standing up and say, what's the G20 here? Who are you talking about? We didn't make any decision here. And so it makes things a little difficult. So having this two-body clother will help.
Mr. Managing Director, we're deeply in your debt for helping to save the world. We're deeply in your debt for your candor and clarity of presentation today. We wish you the best of continued success, and we'll keep in close touch. Thank you.
Thank you, Fred.